my channel. Thank you so much for stopping by. If you're coming here for the first time, my name is Michelle D'Souza. I'm a licensed financial advisor in Ontario. Today I've chosen funds, which is something that I feel you could use as a temporary refuge during these market downtimes. When there is still uneasiness in the market, when you're uncomfortable in putting in a lot of cash, when you think that there is more recession coming your way, that is when I feel these are the funds where you can do a short term investment, where you can park your money for the short term to wait for the stocks which are very good fundamentally, and you can wait for some discounted rates on those stocks and then invest in them. This is the best time to invest in the equity market, but there is always a fear of some stocks reducing in the price further. But then, if you want something to just do a short term investment, these are the funds that you can use. So, without further ado, let's get started. Money market funds. We have heard of mutual funds, we have heard of segregated funds. So, what are these money market funds? These are actually a subset of mutual funds, and these are the subset which fall in the low risk category. So, these are the kind of funds which actually invest in securities, in debt funds, in some kind of US based treasury bills or cash, which is kind of very expensive right now. I'll just walk you through my opinion and also some facts about these funds. It'll also give you an overview so that you can make a decision for yourself after consulting your financial advisor if these funds make sense in your portfolio at this point in time. So, first, let's understand what money market funds are. Remember, these are not money market accounts. So, these are nothing but mutual funds which invest in short term debt securities such as the US Treasury bills, cash, and cash equivalent securities. If you look at money market accounts, or if you look at checking account or high interest savings accounts, these actually are regulated by the FDIC, the federal board, and these give you either fixed returns, very less returns, but these give you fixed returns, and you need to keep your money for a fixed period of time. And generally, these accounts are where you either get your pay slips and you have a lot of transactions, especially in your checking account, right? But money market funds are similar to mutual funds, and these are very different from money market accounts. Money market accounts could be similar to your high interest savings accounts. And money market funds, since they are similar to mutual funds, these are regulated by the Securities and Exchange Commission. Let's move on. Let's look at some of the differences between the money market funds and savings accounts. Since money market funds are a mutual fund, they are still a mutual fund. So there is still risk involved in these funds. However, they are low risk mutual funds compared to some of the equity funds that we have. Whereas a savings account is absolutely no risk. You get a fixed rate of return. A savings account or even a certificate of deposit. Some banks call it high interest saving account. Naming conventions keep changing, but a general savings account has absolutely no risk. In money market funds, you have variable returns. You cannot guarantee a particular rate of return, but in savings account, you always have very low returns, but they are always fixed. In money market funds, especially in downtimes like this, okay, when cash is available at an expensive rate, you have the potential for higher returns. Whereas savings account, I look at it as a temporary refuge to park your money. You should also remember that if you break your term in a savings account, you also have some penalty, you lose some interest. And since this interest is fixed, you have to pay taxes on the complete interest rate. Whereas in money market funds, because it is variable returns, it is still risky. These are considered as capital gains, and you end up paying only taxes on half the capital gains. So there are potential for higher returns in money market funds. However, since these are low risk, They're only best for short term investment. I wouldn't recommend this for your long term investments. It could probably be a very small portion of your portfolio if you're looking at like a 20-year, 30-year horizon. Now, if you're more closer to retirement, then of course your story would be different. You would want some low risk options rather than losing your money in the stock market. Then probably money market funds are a better bet for you. Or you could also look at some kind of bonds, government bonds, debt funds. These are all some low risk options that you can consider during your retirement. Let's move on. There are also some other notable factors about money market funds. We'll just go through that in the next slide. So, the other notable factors are generally in money market funds, you have either very low or nil minimum balance requirement. So, some of the checking accounts have a particular balance requirement. If you do not have a particular balance, you have to pay some monthly fees. Even in some of the equity funds, especially one with the big names, you have a minimum balance requirement because otherwise there is no point of the fund manager utilizing his time and energy to manage your fund, right? So basically, you have some minimum balance requirements for the big names. There are some funds which you could get in your group plans or even as part of your big portfolio. Say, if you're looking at your big investment portfolio, then probably you wouldn't even bother about the minimum balance. But if you're just starting out investing, then these are one of the funds you can consider because this has very low or nil minimum balance requirement. In in addition to that, it has very low expense fees also because managing these funds is relatively easier. And you also have the flexibility of withdrawal without charges. As I told you, if you break the term for a fixed deposit, certificate of deposit is what it is called right now, or GICs, or even your high interest savings account, you end up paying some penalty. But in money market funds, you have absolutely no penalty because these are equal to mutual funds. So there are no charges and there is flexibility of withdrawal. So that is the main difference between a certificate of deposit or a MMA account. And especially because you're still looking at these funds as a short term investment, not having any charges and having positive rates of return, especially in a market like recession, make these funds a better option, especially for short term investments while we are going through a recession and while the interest rates are high. So, this is my take on these funds. In recession, cash is king. Now, that doesn't mean you have to withdraw all the money from your bank and just keep it under your bed, right? Now, that's not what I mean. But having the flexibility to be able to invest in discounted stocks at any point in time, or maybe even buying a house, but being able to have that money parked somewhere where you can remove it immediately, that is one of the best things that you can have, especially in the market downturns. So I feel money market fund is a good fund to invest at this point in time, especially when cash is expensive, lending rates are high. This is one fund which will give you very high yield over the short term. But if you look at it for a long term horizon, something like a 5 years, 10 years, then possibly money market funds may not be a very good idea. But please do your research while choosing the funds. This is just a broad terminology. There are a lot of individual funds under the money market umbrella. So do talk to your financial advisor and make sure you do your research while choosing the right set of funds, even within the money market umbrella. I hope you found this content useful and thank you so much for watching this video, and I look forward to seeing you all in my next video.